Have you ever wanted to own real estate without the hassles of managing a rental property, without the hassles of managing a tenant? Well, there is actually an option for you. It doesn't take a lot of capital. It's called real estate investment trust. And this is what I'm going to talk about today. So if you are interested in owning real estate without all that hassle, then you got to check out today's video. So in today's video, I'm going to talk about what are real estate investment trusts. How does it work? What are the biggest mistakes investors make? And of course, everyone's favorite topic, which is taxes. I know it's like, boo, but you know what? Taxes are important. Hey, by the way, if you don't have a brokerage account yet and you're really wanting to open a brokerage account, basically invest in stocks like REITs, be sure to check out my links below and get some money back. So if you open a brokerage account with Trade, you get $50 of trades for free by opening an account. Or if you like Wealthsimple because you love their platform, then check out my link below. You get $10 back for opening an account. And I thank you from the bottom of my heart for supporting my channel. Now, before we jump into how a REIT works, which is a real estate investment trust, I just want to give you a quick, easy peasy business model of how real estate investing works. Because once you understand that, then you can easily understand how a real estate investment trust works. Now, as a real estate investor, I own rental property. So I'm a landlord. I collect rental income from my tenants, and then I use that rental income and pay out all the expenses like mortgage payments, property taxes, insurance, wear and tear. And after all that accounting gymnastics plus pay the taxes, then whatever rental cash flow I collect is what I keep. Now, real estate investment trust operates very, very similarly. Now, the only thing is that obviously when you go buy a rental property, you need a big down payment. You need to find the right property. You need to find it in the right city, in the right neighborhood, attract the right tenants, manage the rental property, manage maintenance expenses. Like if there's a stove broken, you have to, fix it. So there's all that type of hassle. And if you don't want any of that hassle, then real estate investment trust may be just for you. So real estate investment trust is literally a basket of rental properties, okay? It could be commercial rental properties, it could be healthcare, it could be hotels, it could be malls. It's basically just a bunch of properties where a landlord collects rental income and then they pay out all the expenses, and whatever's left over, whatever that's pure profit, then they distribute about 90% of the profits back to shareholders. And that's where you get like, ooh, really, really, really interesting. Because if you go invest in a REIT, a real estate investment trust, and as a shareholder, you essentially own real estate without all the hassle, what I just talked about owning rental properties. And you collect a little bit of moolah every single month. And if you pick the right real estate investment trust, and if the real estate goes up in value, then you also get rewarded as a shareholder where you get a little bit of capital appreciation. That's going to become really important in terms of the monthly distribution, how it's taxed, which I'll get on that a little bit later in the video. In Canada, the REITs that we have are mainly commercial properties, healthcare properties, hotels, malls, what else? Warehouses. So those are the types of properties that are in real estate investment trusts. And normally the real estate investment trust concentrates in one sector. So you might get a real estate investment trust that just focuses on warehouses. You might get one that just focuses on commercial properties like malls, or you might get one that just focuses on healthcare, like hospitals, nursing homes. Now, there's sometimes you can get a real estate investment trust that does a whole diversified portfolio of properties, but typically they do focus on a certain area or certain niche. Now, one of the great things about owning a REIT, other than not having to come with a ton of capital and manage rental property and manage tenants, okay, besides all that, is that it's super liquid. A lot of REITs are traded on the Toronto Stock Exchange, or you could go to the New York Stock Exchange. There's a bunch of REITs, and they're super liquid, super easy peasy to buy them on your stock brokerage app, okay? And if you are scared about inflation, well, real estate investment trusts can typically do well with inflation because we know real estate tends to go up with inflation. Now, of course, then there's the complication of interest rates going up if inflation's going up, which could hurt, obviously, mortgage payments. So I don't know if I'm super bought in that REITs would do well in an inflationary environment because mortgage rates would also go up. But anyway, if you do want to think in the long term, in terms of just fundamentally, real estate values tend to go up with inflation. Now, here's my favorite part. Real estate investment trusts pay a monthly distribution, like a little bit of moolah coming in back to you every single month, which is awesome. If you are looking for income, if you are nearing retirement, if you are wanting to accelerate and to financial freedom, to quit your job, to retire early, to take a sabbatical, we all love, who doesn't like extra income? And the reason why these REITs have to pay monthly distributions to you because they got super huge tax advantages. As a corporation, they have rules of how they can form as a trust. And one of the rules is that you have to pay 90% of their profits back to you, okay, every single month. So that's a win. That's a win for us. Now, if you are looking to hold REITs in your portfolio and you're wondering like how much you should have in your portfolio, if you're looking for a huge diversification, meaning basically diversification means that nothing will really make a dent in your portfolio. So then you don't put all your eggs in one basket. So all you do is just put no more than 10% real estate investment trust type stocks in your portfolio so that obviously if the market crashes like it did last year, then you don't really take a hit because it's less than 10% of your portfolio. Now, again, I'm not a financial advisor. I'm just some YouTuber, Canadian YouTuber who loves talking about stocks and real estate investing. So please do your own research, do your own due diligence, okay? Now let's talk about the biggest mistakes that investors make when it comes to investing real estate investment trusts. And some of these, if you hear these mistakes and you're like, ooh, you've made them, no big deal, okay? We've all been there, done that. It's okay to make a mistake, just please learn from it. And that's why I'm going to tell you so you can learn from it. So the first mistake is not knowing what type of real estate investment trust you own, okay? Because real estate investment trust comes in all shapes or forms. It could come in warehouses, it could come in malls, it could come in healthcare facilities like nursing homes. So if you have no idea what you're investing in, maybe you shouldn't invest in a real estate investment trust. Maybe you shouldn't pick stocks. Maybe you should just go out and pick an ETF where it like basically picks the biggest companies in a market. So you can actually invest in ETFs, which are focused on real estate investment trust if you don't know what type of REIT to choose. But if you do decide to choose a REIT and you want to concentrate in one area, just make sure like it's an area that you know that's going to do well in the future. Maybe like healthcare might be a good staple to have. Maybe you want to focus on warehouses. Just make sure that you just know what you are investing in, because one of the biggest mistakes I find is that people don't know what they're investing in, and then they're surprised if the market doesn't do well. Well, you didn't actually do your research, that's why. Now, the second biggest mistake that investors make, and I sometimes make this mistake, which is chasing yield. You're like, well, and how you check yield is that you go to any website and you put the ticker symbol of that stock, of that REIT, and then you can say, go to Yahoo Finance, put the ticker symbol, and then look in, and there's the yield, okay? And it shows you, ooh, it's like, sometimes it's like 10% or 9%. You're like, ooh, that looks super enticing. But before you get too excited about looking at that yield, just ask, please ask yourself, why is the yield so high? Maybe it's a trap. So you gotta pull back the curtain, even if you really don't want to, you gotta really pull back the curtain and check out why is the yield so high? Because the reason why yield could be high is it could be a big fat trap and they wanna sucker you in. Now, the way they do that is like maybe the operations of that business isn't doing so well. So think about it. If you all of a sudden got a ton of distributions from that REIT and you saw a yield that's 9%, when you pull back the curtain, you find out that they pay like 98% of their profits back to you every single month. Now just pause right there. Think about it. It's like if you pay 98% of the profits every single month and then all of a sudden something goes wrong with the company, Well, they're probably going to stop paying their distributions to you because they can't afford it. Okay. If anything happens, like COVID crash last year, maybe there's a big expense, unexpected expense that like had to, or there's a bunch of vacancies in those properties, then that wipes out their profits and then they could really cut their distributions, which is a nightmare for income investors. Now, I'm just saying, if you want to see what's a great, safe way of playing real estate investment trusts, always check out the payout ratio. Now, payout ratio doesn't really apply to REITs. It's actually called funds from its operations, which basically is simply their cash flow that they pay out to you. So make sure that they don't pay out more than 75% of their funds back to you every single month, because if it's over 75%, there is a pretty good chance they may cut distributions because they can't afford it, especially if anything goes wrong like last year. Now, before I talk about the 3 tax rules you must absolutely follow if you really want to save a ton of money, be sure to smash that like button if you found this video super helpful, and subscribe to my videos by hitting the subscribe button and that bell notification button to get the latest and greatest videos coming to you. Plus, it's free. So here's the 3 simple, easy peasy tax rules for REITs. Now, the first tax rule: if you are wanting to buy US paying real estate investment trust distributions because the distributions look great, there's more variety and more options in the US market, totally understand it. Just please make sure you invest it in your RRSPs. Avoid any other registered account because there is a 15% withholding tax between the US and Canadian government, and there is no way out of it. So please, if you're looking to invest in US REITs, only invest in your RSPs. Second rule: if you're looking to invest in Canadian REITs, well, you have a lot more options. You can invest in your TFSA, you can invest in your RSP, you can invest in your LIRA, you can invest in your any registered account essentially and collect it tax-free as long as you hold it within the registered account. Number 3 tax rule. Okay, this is going to save you a ton of moolah because I made this mistake where if you decide to invest in real estate investment trusts, if it's either US or Canadian REITs, don't invest in your corporate account unless you want to pay extra taxes, okay? Because real estate investment trusts are taxed a little bit differently, say from Canadian dividend stocks, okay? Because they pay a little bit of capital gains, they pay a little bit of dividends, and then they also pay a little bit of income, interest income. And all those 3 forms of income has a different tax rate, which gets a little bit complicated. So if you want to be super tax efficient, I would just avoid real estate investment trusts. Stay away from them from your corporate accounts, which are really non-registered accounts. So if you have an extra moolah sitting around your cash account, I wouldn't use that to invest in REITs unless you really want to pay some extra taxes. Hey everyone, if you found this video super helpful, I hope so because it gave you a ton of valuable content. Smash that like button. Anyways, I'll see you next week.